How did safe home loans turn into a global financial bomb in 2008? If everyone used risk models, why did the system still collapse almost overnight? The 2008 crisis wasn't just a housing crash, it was a trust crash, caused by turning bad loans into AAA stories the world believed. Want to see the magic trick step by step, and the moment it breaks? What do you think happens next? In this story, the main character is something you can't hold: trust. For many families, a home felt like the biggest dream prize. People heard a simple message: everyone deserves a home. Banks and lenders started saying yes faster than ever. If house prices keep rising, would you rush to buy too? Many buyers brought tiny down payments, just a few coins. A common pitch was, don't worry, refinance later. TV and neighbors made houses look like easy treasure. The feeling spread: if I wait, I'll miss out. But what if prices stop going up? Still, bigger dreams meant bigger loans. Low interest rates made the monthly payment look small at first. Money from around the world flowed into home loans like a river. Rising prices felt like a safety net under everyone's feet. Does easy money always feel like a gift? More buyers pushed prices up, and higher prices pulled in more buyers. Warnings popped up, but they were easy to ignore. Many people believed housing won't fall everywhere at once, so what could possibly go wrong? Now meet Subprime. It's a loan for a borrower with a wobbly money story. Because it's riskier, it often costs more each month. Some loans hid the danger in tiny fine print. Many were adjustable rate, like a thermostat that can suddenly turn hotter. Would you pick a tiny payment now if it grows later? Mortgage brokers earned money for each deal. Ding! Here's the twist. Lenders didn't plan to keep the loans, they planned to sell them. That's moral hazard. If you don't keep the risk, you don't fear the risk. So, who ends up holding the hot potato? Some loans checked almost nothing, like a test with no teacher looking. That let weak loans slide through the machine. Teaser rates were like training wheels that suddenly fall off. Some borrowers got stuck with penalties like glue on the floor. And some people bought extra houses to flip, like trading cards. If you thought you could sell tomorrow for more, would you buy today? Lenders competed to approve loans faster and faster. Loan papers piled up like an unstoppable snowball. Does a bigger pile mean a safer pile? The whole system depended on one thing: someone always buying the loans. Next stop, Wall Street's factory, where loans became products. First, securitization, bundling many mortgages into one big box called an MBS. If one lunchbox is bad, does the big box stay okay? Investors bought pieces and expected a stream of payments back. Then tranches, like a layer cake, top layers get paid first. Which slice would you pick, the top or the bottom? Losses hit the bottom first, so the bottom got squished. Wall Street took the risky leftovers and baked a new cake, a CDO. Is a rebaked cake automatically safer? Some products stacked risk on risk, like a tower of cakes. Rating agencies acted like judges, giving safety stickers. AAA was the gold star sticker, top safety on paper. Would you trust a sticker if you never saw inside the box? Investors around the world wanted a little extra return, extra coins. Many models assumed problems wouldn't happen everywhere at once. But if lots of houses fail together, even safe layers get hit. Here's a conflict. The seller often paid the sticker judge. If the judge is paid by the seller, what could go wrong? Complexity became a cloak, like hiding a red ball under a hat. Watch the hand: risky loans, tranches, tree CDO, AAA, ready for the scary part. What happens when the trick stops working? Time to meet the cast. Everyone had a role. Borrowers chased keys and got trapped by changing payments. Would you sign if you only saw the first tiny payment? Brokers chased volume, like collecting stamps for prizes. Lenders chased fees, then pushed the loans out the door. If you sell the loan tomorrow, do you worry about next year? Big banks built the products and earned fees at every step. Rating agencies stamped AAA, opening the gates for buyers. What if the stamp is wrong? Investors wanted safe plus extra, like a bigger cookie for the same price. Regulators were the referees, but they were often behind the play. If the referee looks away, do players follow the rules? The story everyone loved was, housing always goes up. People repeated the story until it felt like a fact. This was a perfect crime, no single villain, just a broken game. Can lots of smart choices add up to a dumb ending? Trust held it all together, like glue in a tower of blocks. But trust can be fragile, like glass. Here's the trap. People got paid now, while risk waited later. If you got paid today, would you care about tomorrow's storm? Then the ticking clock started. Teaser rates were about to reset. When the timer hit 0, payments jump fast. In 2006, home prices peaked. Then the up arrow stopped. When the elevator stops, do you feel that little drop in your stomach? The refinance later door began to close. Then resets hit, and payments grew like a balloon. Some borrowers couldn't pay, so bills started piling up. One missed payment didn't seem huge until it spread. One domino was small, but what if there are millions? Investors saw their safe boxes losing value. Ratings fell too. AAA stickers got ripped away. Now a scary question appeared. What is this stuff worth? On Aug 9, 2007, BNP Paribas froze funds because the market evaporated. If nobody knows the price, would you buy it? Trust started leaking out like water from a pipe. Lenders shut the loan faucet, making new loans harder to get. More for sale. Signs popped up, and fewer buyers showed up. The crack spread from houses to the whole money system. Now meet liquidity. It means cash you can use right now, like water in a cup. What happens if the water stops mid-pipe? Banks began asking, who is holding the bad risk? When banks don't trust each other, they stop lending to each other. Fear rose fast, like a thermometer shooting up. Would you lend your lunch money to someone you're not sure you can trust? Many big firms borrowed short-term money to hold long-term stuff, like borrowing a toy every night. When short-term lenders said no, firms had to sell assets fast. Fast selling made prices drop, like a clearance pile. If everyone sells at once, do prices go up or down? Trouble spread to other markets, like dominoes jumping lanes. Leaders tried adding cash to the system, like pouring water into dry pipes. But scared banks hugged cash instead of sharing it. Why does fear travel faster than facts? Markets froze. Trading got stuck. Margin calls yelled, "Pay now," like an alarm. Forced selling caused more losses, which caused more fear loop. The big dominoes were starting to wobble. In early 2008, big firms started tipping dominoes falling. If one big domino falls, do the others stand straighter or start shaking? By late summer 2008, cracks spread across the financial wall. Then September arrived, and the calendar flipped fast. On Sept 15, 2008, Lehman Brothers failed. Trust snapped. What if you wake up and a giant bank is just gone? People panicked and tried to grab safety all at once. Even cash-like funds got hurt. One fell below 1. If even safe cash can lose money, what feels safe now? One day later, AIG needed a rescue, an 85B lifeline. Governments and central banks rushed in to stop the domino line. But the shock went global. Banks and investors everywhere got hit. How can one country's houses shake the whole planet? Companies struggled to borrow money for everyday things, like paying workers. Families felt it too. Jobs disappeared and budgets shrank. Rescue plans were like emergency repairs on bursting pipes. The real collapse was trust. Once it broke, everything jammed. After the storm, everyone demanded a new rulebook. After 2008 came new rules. Guardrails for the money highway. If you fix rules, do people change too? In the US, reforms like Dodd-Frank tried to tighten safety checks. Banks were pushed to hold bigger cushions so they could take hits. Loan rules also tried to make tricky loans harder to sell. Should we block tricky loans or teach everyone to spot them? But the scars stayed: foreclosed homes and empty streets. Many people lost jobs and families had to tighten belts. Afterward, people argued about fairness and inequality. Is it fair to save banks when families lose homes? Trust in big institutions cracked and took years to rebuild. Countries shared lessons and tried to strengthen the whole system. Lesson 1: Incentives matter. Paying for speed can create sloppy work. Lesson 2: Leverage is like standing on a tall stack of blocks, easy to tip. Lesson 3: Opacity means can't see inside, like a mystery box. If you can't see inside, how do you know what you own? Closing thought: it began with a good story, homeownership for everyone. It ended with a dangerous story, bad risk disguised as safe, until trust collapsed. Did we fix the incentives or just patch the pipes?